The US stocks are currently at levels that seem to defy the economic realities that businesses are facing as a result of the pandemic, and market experts are wondering whether it's a bubble or not. Most recently, billionaire investor Ray Dalio, who is the founder of Bridgewater Associates, the largest hedge fund in the world, said that the stock market is a bubble and is halfway in magnitude compared to previous bubbles that triggered historic market crashes such as the Great Depression and the dot-com bust. According to Dalio, some high-performing stocks have already benefited from the single-minded and speculative trading focused on price. He attributed this recent volatility in the market towards a rotation in the meat and potato companies that did not benefit from trades during the pandemic as tech firms did. He continued to say that, "What happens is that a lot of new technologies, new ideas, and many other things come along and make fabulous revolutions. These can grow new things, which is great, but unfortunately, there is a tendency of extrapolating the past by investors. They do not focus much of their attention on the prices, and eventually, a bubble emerges." So, what is a bubble? The bubble is an economic term that refers to a situation where the prices of different things such as financial assets, individual stocks, or an entire market sector exceeds the fundamental value and by a large margin. Asset bubbles, also known as financial bubbles or economic bubbles, normally fit into four main categories: market bubbles, stock market bubbles, commodity bubbles, and credit bubbles. Bubbles can be unpredictable and deceptive, but understanding the 5 stages that the bubble goes through can be a great help to the investor. These 5 stages are displacement, euphoria, boom, profit-taking, and panic. The damage caused by the bubble bursting depends on the specific economic sectors involved. Also, the extent of the sector's participation, localized or widespread, and the extent to which the debt-fueled investments had inflated in the bubble. Growing fears of the bubble. The recent warning from Dalio echoes the growing concerns that some investors have. Dalio said that the bubble was an unsustainable high price, and he measured it using the following 6 parameters. How high the prices are, relative to the traditional measures. Whether the prices are discounting unsustainable conditions. The number of new buyers, who were not in the market previously, have now entered the market. An analysis of how broadly bullish sentiment is. Whether purchases are being financed through high leverage. Whether buyers have made extended forward purchases to protect themselves from any future price gains. According to Dalio, each of these parameters is measured by using several stats combined in gauges. The stock market does it for each stock. The gauges are added to the aggregate indices through security and then done for the market as a whole. The aggregate reading is derived through a combination of gauges in one stock market, which goes all the way back to 1910. This shows how equity conditions in the US stack up now, in comparison to the past years. In actual sense, the bubble gauge is currently in the 77th percentile for the overall US stock market. There is quite a huge difference in the stock readings. There are some experiencing high bubbles according to the measures, and particularly the new tech companies, while some stocks are not in the bubble at all. In the below charts, we take a look at some of the US companies currently in a bubble. This represents 5% of 1,000 top companies, and the measures show that they are in fact in a bubble. Stocks from the bubble companies were taken to form a bubble basket of stocks that need to be watched. The below chart is a representation of performance by 500 of these companies. Ray Dalio's quotes on the bubble. Dalio says, "There is just way too much money that has been injected in the economy and the market, e.g., in casinos, and people are playing with fun money. They are buying all types of things and trying to push down on yields for everything. In this way, you have stocks going up, which causes a classic bubble dynamic on many different assets. The increased money supply that has been injected in the system bids up the investment asset prices, and this can cause a financial market bubble even when the real economic conditions are weak. Bonds are in a 40-year bull market, which has been rewarding long-term investors and penalizing the short-term. The bull market has produced many comfortable longs who are not seriously stung by the price decline. This is one of the classic markers of a bubble." Dalio's quotes on bond market wars. The economics of bond investments, which are mostly financial assets, has turned stupid, and if you buy bonds in either Europe, the US, Japan, or China, you will be guaranteed of having a lot less buying power in the future. In case the prices of bonds fall significantly, this would produce great losses for the holders and encourage more selling. A bond market sell-off is likely to be traumatic to those who hold debt assets and almost everyone else, although it eventually may reduce the ratios of debt service to incomes. Also, it is traumatic for capitalism, capital markets, and economies. During the debt-credit collapse, people are likely to realize that they do not have much buying power as the financial and economic conditions get worse. Here's why you should worry about the stock market bubble. Well, an increasing number of Wall Street professionals have been talking about bubbles in the last couple of months. They have seen the hefty price increases on everything from Bitcoin to equities. The current rise in the prices of new homes and the soaring value of newly public companies are clear signs of a financial system on the verge of a major reset, which is similar to what had happened in 2000 and 2008. Jeremy Grantham, a legendary money manager, thinks that this time things will be even worse, and there is a high likelihood that this crash will rival what happened in 1929 in terms of severity. But is it all true? The fact that stocks have been running up in aggregates of 80% after they dove in March, during the first weeks of the pandemic, and the Bitcoin has gone up by nearly 5-fold, and that Tesla has also soared by more than 8 times and is set to become bigger than any other global market, shows that everyone should think more about the bubble. Whether it's true or not, remains to be seen, but there are some factors to consider. Dalio has been right before. He predicted the 2008 crisis accurately, and his firm was one of the few companies that had assets growing in that period despite the warning signs. Dalio says that his depression gauge, which had sent out an alarm before the last crash, is not on. And, while it may not be in a bubble just yet, Dalio says that the economy of the US is in a pre-bubble stage that has a high chance of stumbling into recession this year. Dalio has a net worth of $18.1 billion, and he is currently promoting his new book, A Template for Understanding Big Debt Crises, which delves deep into examining past financial crises, such as the Great Depression of 1930 and the 2008 financial crisis. A pre-bubble economy means that investors are required to become more defensive with the current environment in the market, and they should not underestimate the increasing risks caused by the bubble. Let's wrap up. The damage that is likely to be caused by the bubble will depend on the economic sectors involved. It also depends on the participation of these sectors and whether or not they are localized or widespread. This, we have mentioned above. It is also possible that everything will already have changed by the time you get to read this piece. It is also possible that it may all change back the day after you have had a chance to read this. The financial markets are weirdly resilient, and it is unlikely to see any changes in the foreseeable future. This will frustrate the bubble watchers and even confound people who rightly noted a yawning divide between labor and capital. However, for now, the only evidence of the bubble in the market is the number of people predicting the burst. You should consider betting against them before you bet against the market, but then again, if history is anything to go by, people like Ray Dalio seem to understand a thing or two about the financial markets, which means that you may not want to bet against him.